Meta just posted a 33% revenue jump and a 10.44 earnings per share figure that crushed consensus by 57%. On those numbers alone, the bull thesis looked airtight. Then came the breach that the numbers could not price. Scale AI, the data labeling company into which Meta poured $14.3 billion just weeks ago, left confidential Meta AI training materials sitting in unsecured, publicly accessible Google Docs. Some files were not just readable, they were editable. Business Insider reviewed 85 documents totaling thousands of pages before the story broke. Contractors who worked inside the system described it on record as incredibly janky. That word matters more than it sounds. Janky does not describe a sophisticated attack. It describes a structural failure in the very vendor Meta selected to anchor its superintelligence roadmap. Mark Zuckerberg personally handpicked Alexander Wang to help lead that roadmap. The $14.3 billion was not a passive stake, it was a strategic dependency signal. The prior thesis on Meta's AI buildout rested on a specific chain. Massive Capex commitment funds elite data infrastructure. Elite data infrastructure produces training advantages. Training advantages compound into product moats. Scale AI was positioned as the critical second link in that chain. What the breach reveals is that the second link was load-bearing, but not load-tested. Google and Microsoft are now reported to be backing away from Scale AI. OpenAI had already been phasing out its involvement for months. That migration pattern is the market signal that the breach is not an isolated incident, but a pattern recognition event. When three hyperscalers independently move away from the same vendor, the vendor's institutional trust has already crossed a threshold, quietly before any single headline. The question the numbers left unanswered is now audible. Meta did not just invest in Scale AI's revenue, it invested in Scale AI's credibility as the custodian of its most sensitive training data. Those are not the same asset, and only one of them just took a direct hit. Meta raised its 2026 capital expenditure guidance to a range of $125 billion to $145 billion. That figure was framed at the time of Q1 earnings as evidence of conviction. The company was accelerating into AI infrastructure at a pace that most competitors could not match. JP Morgan downgraded the stock anyway, stating that Meta has a more challenging path to returns compared with rivals. Bank of America added that the investment cycle is proving bigger than expected, with returns less clear than those of cloud providers. What analysts were pricing was spend risk. What the Scale AI breach adds is a different category of risk, execution quality at the vendor level. Those two risks compound rather than cancel. Here is the point most observers are missing. The breach does not primarily threaten Meta's data security in the traditional sense. It threatens the institutional credibility of the training pipeline at the exact moment Meta is asking the market to value that pipeline as a strategic asset worth $14.3 billion. The ECB has already begun summoning banks over AI model security risks. That regulatory signal travels upstream. When financial regulators begin auditing AI model provenance, the question of where training data was stored and who had access becomes a compliance variable, not just a reputational one. Meta is simultaneously restructuring 10% of its workforce and moving 7,000 employees into AI roles. That internal reorganization requires the external data infrastructure to function reliably. A vendor whose document management system contractors call janky is not the stable foundation that a $125 billion Capex cycle demands. The restructuring thesis, that Meta is reorienting toward AI efficiently, now depends on whether Scale AI can be replaced, remediated, or ring-fenced before the next training cycle begins. Scale AI spokesperson confirmed the company has disabled public document sharing from its managed systems. That is a corrective response, not a structural one. The condition that would resolve the risk is not a policy change at Scale AI. The condition is independent verification by a credible third party that the training materials already exposed did not compromise the integrity of the models built from them. Until that verification exists, the training pipeline thesis carries an asterisk the market has not yet fully priced. Meta stock was already trading 11% below its level 1 month ago, despite the earnings beat. The breach arrived into a stock that was already absorbing downward pressure from the Capex return skepticism. It did not create the selling, but it removed the counter-argument that the strategic investments were being managed with the rigor the spend level implied.
CoreWeave holds a $99 billion revenue backlog and has posted triple-digit revenue growth. Its central value proposition is being the AI compute infrastructure layer that hyperscalers route through when their own capacity is constrained. Meta is one of its most significant clients. That relationship is what makes the scale AI breach a CoreWeave variable, not just a Meta variable. The logic runs as follows. Meta's $125 to $145 billion Capex cycle funds AI infrastructure buildout. CoreWeave captures a share of that buildout through compute contracts. If the breach triggers a reassessment of how Meta sequences its AI training pipeline, if legal exposure, regulatory scrutiny, or vendor replacement costs slow the pace of Meta's AI deployment, the demand signal that supports CoreWeave's backlog execution timeline shifts. CoreWeave stock has already pulled back 14.58% over the past month. That drawdown preceded the Scale AI breach. The question now is whether the breach adds a fundamental reason to the technical pressure, or whether it remains a reputational story that stops at Meta's balance sheet. The answer hinges on one specific variable: whether Meta's AI trading roadmap experiences a meaningful delay. A delay does not need to be announced publicly to affect CoreWeave's revenue recognition timing. Backlog is a commitment, not a guarantee of delivery pace. If Meta pauses, audits, or restructures its relationship with Scale AI, the compute demand that flows downstream to CoreWeave follows the same timeline shift. The recovery path for both names runs through the same gate. If Scale AI produces credible third-party verification that the exposed materials did not contaminate the models, and if Google and Microsoft's reported withdrawal does not become a formal contract cancellation, the breach resolves as a compliance incident rather than a strategic fracture. In that scenario, Meta's training pipeline thesis survives, the Capex cycle maintains its velocity, and CoreWeave's backlog converts on schedule. But the $14.3 billion that Zuckerberg deployed into Scale AI now carries a dual burden. It must deliver the training advantage it was purchased to provide, and it must do so while the vendor is under investigation, its institutional clients are distancing themselves, and regulators in Europe are signaling that AI model security is becoming a supervised risk category. The checkoff element here is the number itself, $14.3 billion. That figure began this story as a signal of strategic conviction. Whether it ends as a sunk cost or a defensible foundation depends on whether the next 90 days produce verification, not just remediation. That is the monitoring variable. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.